Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook. Today is Thursday, 27th of September 2012. Not much action seen in the markets during the past 24 hours. A slight corrective action seen on euro and sterling, while dollar yen remains quite under pressure despite yesterday's brief move on the Bank of Japan Sato's comments for readiness for action, with the dollar Swiss as expected having difficulties on attempt to break important 94 barrier. As we said yesterday, some easing and hesitation could be expected. This is exactly what happened, and it seems that the pair is now building a base for a fresh attack higher. Crude oil remains under pressure, or following what we said yesterday, that increased the fears of further slowdown in the economies basically pushed, as well as yesterday's U.S. crude stocks pushed the oil price significantly lower, breaking below $90 per barrel, hitting 88.94, so approximately $89 per barrel ahead of current brief corrective action. While yellow metal also, after a sharp dip yesterday to 1757, now is slightly recovering, but still range, 1737, the breaking below the range could be a signal of some stronger corrective action. This is what we were mentioning in our previous sessions. From the fundamentals and the news, Spain of course remains in focus these days, as Spain is expected to pass reforms, the budget cuts, and the eye of course being on the aid from European Union, and the country will, the government will announce a series of economic reforms and the tight 2013 budget on today's meeting, aiming to avoid the political humiliation of having Brussels impose conditions on a request from international bailout. The Prime Minister will enact further cutback as his efforts to bring down one of the Eurozone's largest public deficits have been undermined by falling tax revenues in recession. The comments from the Prime Minister he said that we know that we have to do what we have to do, and since we know it, we are doing it. He said in the speech in New York yesterday, stating also, we know that this entails a lot of sacrifices distributed evenly through the Spanish society. Thousands of anti-austerity demonstrators demanding that Prime Minister will resign gathered for a second day yesterday in Madrid near the National Parliament, which was guarded by hundreds of police officers. Reforms in Spain intended to win over skeptical investors and control spending are likely to include a new tax oversight body as recommended by Brussels, limitations in early retirement, new taxes and greenhouse emissions and stock transactions, and eliminating some tax exemptions, of course, including wage freezes for public servants will be extended into 2013. And of course, Spain is negotiating the terms of a European aid package that would trigger European Central Bank bond buying program and ease Madrid's unsustainable borrowing costs. The reforms are to be announced today, and meant to preempt the conditions that would be attached to the aid. So we are close, I would say, to sort of a solution for for Spain. That is, of course, now the number one, the focus of the European Union, with another significant thing being yesterday's comments by Japanese officials in his interview, Bank of Japan official Sato, who said that Bank of Japan is ready to expand monetary stimulus again, even after this month's action, and may ponder new steps if necessary, warning of global uncertainties that could push the economy into recession. In an exclusive interview with Reuters, Sato also said Japan may not achieve the Bank of Japan's 1% inflation target as early as the central bank had hoped, issuing the strongest warning to date by a policymaker of risks to the country's recovery. His comment was that we won't hesitate in taking additional monetary easing steps if we feel that the risks have been heightened enough and that the economy might undershoot our forecasts even after this month monetary easing. This is what basically we mentioned in our previous sessions as strengthening yen and the other signals of easing in the Japanese economy are now keeping the Bank of Japan at high alert for a possible stronger and immediate action in case of things going worse. From today's calendar that is quite rich as we are in Thursday, we are going to take a look now. The import prices from Germany, we don't have the update. This is the one because our calendar has some technical problems and we have to use this temporary solution. The German the German import prices came at 1.3% on the monthly basis compared to 0.8% in the forecast. Actually, we have this, and the 3.2 import prices year on year. Still to come from Germany, unemployment rate that is expected to stay unchanged at 6.8, with the unemployment change of 10,000 compared to 9,000 in the August. From the Eurozone at, this is at 7:55 GMT, at 8 o'clock GMT, Eurozone M3 money supply for 3 months is expected to stay unchanged at 3.4%, while yearly release for August is expected to dip to 3.2% compared to 3.8% July's release. UK's current account for the second quarter is due at 8:30. 12 minus. The gap is expected to widen to 12.4 billion pounds compared to 11.2 billion pounds in the first quarter. Along with this, we have GDP, quarterly GDP for United Kingdom for second quarter minus 0.5, unchanged. The figures on quarterly and the yearly basis. With the total business investments for the second quarter expected slightly to dip. 1.7% is the consensus for today on the yearly release, while quarterly is expected to dip more significantly to minus 1.5% compared to 1.9% in the first quarter. Eurozone the business climate for September due at 9 o'clock GMT is forecasted showing slight improvement, minus 1.19. Still, of course, in the negative territory compared to minus 1.21, while consumer confidence is expected at minus 25.9, worsening from August release at minus 24.6. This is the consensus for today. And economic sentiment indicator for Eurozone September is expected to stay unchanged at 86.1. Industrial confidence for Eurozone September minus 15 compared to minus 15.3, and services sentiment is expected slightly worse from previous release of August, which was minus 10.8 at minus 11. And that is all from the European side. America starts at 12:30 GMT with the series of releases. Durable goods orders for August are forecasted at minus 0.5% compared to 4.2% in July, revised from 4.1%. Core durable goods orders are expected to improve by 0.3% compared to minus 0.4% in month of July. GDP for the second quarter is also forecasted lower, 1.7%. Decrease in the gross domestic product of America compared to first quarter's 2%. Initial jobless claims at the same time, 378,000 new claims forecasted for this week compared to 382,000 jobs in the previous week. Slight improvement, but nothing that significant, and pending home sales at 1,400 monthly release are expected to stay at zero compared to increase by 2.4% in the month of July, and the natural gas storage for September, week of September 21, are expected to show build of 75 billion cubic meters compared to 67 billion in the previous week. And that's all for today from the economic indicators, and we're going to start our technical part now and take a look in the instruments, see what we should be expecting during today. As calendar is full, and we might expect some action based on fundamentals. Now we're going to take a look on the technicals and see, as shown on the hourly, even better on the 4-hour chart, the euro is still in descending mode of double top at 131.70, 17th of September peak, with fresh low being posted yesterday at 128.34. This is just ahead of our downside targets. The initial one is 200 days moving average at 128.24, and then two trend lines broken, bear trend line of year's peak at 134.85 at 127.90, and the ascending trend line connecting 122.54 and 125.00, currently standing at 127.70. So cluster of strong supports just below yesterday's low, and these are basically our targets, as we assume that corrective action should dip somewhere below 128, as worsening situation in the Eurozone now regarding Spain still sees more pressure towards the downside on the Euro's near-term outlook, with the indicators on the daily chart started to move lower, and the significant loss of initial bullish momentum sees increased downside risk. A brief look at the near-term action, as bounce of yesterday's fresh low at 128.34 seems to be so far short-lived, as 129 level as psychological resistance. It's also hourly 55 days exponential moving average so far capping the upside, limiting gains. Not much of the action to be expected, with the still weak hourly studies. MACD is approximately about at zero line, while momentum, despite gaining some ground, is again pointing lower. All other indicators are still in descending mode. Unless we see break above the trend line, which is around 129.24, not much to be expected. With this seen as a trigger for some stronger corrective action. The near-term key barrier at 129.70 is seen as a basically as a break point, as this regain of this level will signal near-term bottom at 128.34 and allow for some stronger corrective action. With the, we're going to take a look on this chart to see some Fibonacci levels that are important at this point, approximately marking approximately 38.2%, so quite a good break point to turn the near-term focus higher in case we see regain. Otherwise, any failure under either trend line or 128.70 would see risk for a lower top and extension of this downtrend from 17th of September peak, with the downside targets as mentioned 128.24, 128, 127.90 and 127.80, quite strong obstacles for the single currency. Of course, break of these levels in case of a further extension lower would be a good trigger for a fresh weaknesses. Also, we have 127.40 significant, 127.40, 45 significant previous high, with the other one at 128.23 equivalent to the 200 days moving average. This point, I would say, for the near-term action, still probability of some push higher not ruled out, but more pressure seen at this point towards the downside. And as said, unless we see break above minimum trend line at 129.24, not much of the action upside action is to be expected today. And the sterling found a temporary support following yesterday's initial support at 161.50 and the subsequent bounce up to 162, where the gains were capped. Fresh weakness extended briefly, posting marginally fresh low at 161.36. That basically dented the initial range at 161.62 to 163.08, moving now from sideways more towards the downside, with the 4-hour charts now firmly in the negative territory, seeing a potential for a stronger corrective action of the latest cables up, like from 157.69 to 163.08. As we mentioned in our previous sessions, the 163 zone proves to be quite a tough barrier for now, and further hesitation and the corrective movements are expected. On the daily, the indicators now move out of the overbought territory, and that could be one of the signals for some stronger move lower. So far in the near term, a bounce of 161.36 has been limited by initial psychological barrier at 162.00, but improving hourly structures still sees potential for some corrective action towards the upside, with the trend line resistance at 162.23 currently seen as the next barrier, and basically break above this. It's important that the pair will first make break above 162. That will be first signal of basing, and then confirmation will come at break above 162.24. That might dent the current near-term downtrend of 163.08, with the break above these levels. That also marks approximately 50% retracement of the down leg from 163.08 to 161.36, seen as a trigger. On the upside, the break above, more important, 162.42, 61.8% retracement, and the congestion tops at 162.60-70 zone is seen, is required basically to confirm the bottom, and then focus up towards the 163 zone. As said, improving hourly studies, but still weak indicators in the 4-hour chart are still seeing not much prospect for stronger corrective action. As said, also the daily studies are daily indicators are moving lower, and this could be signal for some a stronger corrective action, although the uptrend is still larger uptrend is still intact, and this move on the larger picture is seen just as a brief corrective action that cannot harm more seriously the uptrend of 152.67. This is 1st of June yearly low of cable. And the dollar yen, we mentioned in our yesterday's comments, positive sentiment established briefly after comments of Japanese Bank of Japan official did not show much of the action, as basically the rally was limited at initial barrier at 77.90, and that was all seen so far. As the further easing dipped down to 77.60, just ahead of 77.58, yesterday's low. At this point, more pressure seen towards the downside, with the negative tone seen on both 1 and 4-hour charts, as 20 days exponential moving average is maintaining the latest down move. I would say not much prospect seen for some corrective action. From the other side, the larger picture studies are still negative, as long as we stay below 79.20, which is 79.30 previous peak, and the 200 days moving average, more pressure and more focus seen towards the downside. Of course, we have to consider that comments from Bank of Japan. It's official that they are ready to act at any time. So any further easing lower could be a trigger for their action. At this point, more focus still towards the downside with the 77, a loss of 77.58 seen as a immediate trigger for 77.12 and 77.00, our next downside target, following a recent slide upon upside rejection at 79.21, 19th of September peak. And the dollar Swiss, as we mentioned in the introduction, had of course some difficulties. 94 tough area, 200 days moving average, and approximately 50% retracement of the latest down leg from 95.77 to 92.37, along with the previous peak and lower top at 94.16. Proved to be tough resistance, and the corrective easing followed. Now the 93.73 has so far contained the latest easing with some action moving higher, seen at the opening of European session. Possibilities of fresh extension higher are still quite high, though the study indicators on the 4-hour chart, despite being in the positive territory, are moving sideways and slightly towards the downside. This could be an early signal. Of course, a break below 93.71, which marks the dynamic support of 20 days exponential moving average, and the further down 93.58, 55 days, one equivalent to the previous peak of 20th of September, could be a trigger for a deeper reversal, with the confirmation of this seen on a possible break below 93.26 2 days ago, a low that will signal temporary top and allow for further easing. Any reversal above, in case of further easing, any reversal above 93.26 would be still seen as a corrective action, and still keep hopes of fresh attack at 94 zone, break of which is to confirm the bottom at 92.37 area, and they allow for a stronger recovery with the 94.47, 61.8% retracement, and the 95 zone seen on a break upside. And the gold is in the near-term recovery mode, following yesterday's sharp dip down to 1736. Of course, this, as we mentioned at the beginning, has dented the recent range, and actually broke below the consolidative range that was limited on the downside at 1750. I think this was also the approximately there exactly was for our chart Ichimoku cloud base that was offering an additional support to the gold's price, with the subsequent bounce higher, now attempting to regain the previous lows at 1755, with 1757, 1759 seen so far. The hourly studies are in slightly improvement mode as the price moves higher, and the 10 days moving average crosses above the 20 days one that is now moving sideways, but 55 days one is still limiting the upside. I think we need to see some more gains towards 1765 and more significant 1774 in order to confirm the bottom at 1736. Otherwise, any failure under 1774 could be a signal of possible stronger corrective action. Also, we have the near-term trendline resistance currently at 1765. So it's equivalent to the previous peak of yesterday's intraday, yesterday's high, break of which is to reattract the 1774 hour break point. Otherwise, more risk seen towards the downside, as loss of 1736 is to open levels down at 1733, and trendline support at approximately 17.28. So these are our initial supports ahead of 17.16 and the 17.00 round figure support, as well as 61.8% retracement of the up move from 1646 to 1787, 1787, the recent peak of 21st of September 2012. And finally, I do apologize for this. I don't know whether you hear it. We have a fire alarm here, so I really don't know whether it's the real fire or it's just a drill. We will find out soon. From crude oil, just to mention that additional pressure was seen on yesterday's release of crude oil stocks that pushed the price lower down to 88.94, further weakening the structure and looking for further easing following upside rejection at 100.72. On the larger picture, we have seen so far a break below our initial targets, 89.76. That was 90 days moving average, and so far retracing exactly 50% of the corrective up move from 77.27 to 100.72. As daily structure is further weakening and indicators now moving into the already moved into the negative territory. More prospect seen towards the downside as pressure comes also from the news and the negative sentiment based on weakening Eurozone and the other world economies that will be direct trigger for a lower demand of the oil. That is basically now main driver, of course, with that losing some important technical points and the weak studies being additional pressure. Break below the yesterday's low at 88.94 sees extension down towards another important zone. It's a higher platform at approximately 86.90 zone ahead of 86.11, which is 61.8% retracement, break of which, of course, to confirm the lower top at 100.72 as part of a larger downtrend from 114.80, the peak of 1st of May 2011, with a lower top at 110.53, a peak of 2012, and currently this we have the lower top at 100.72. As said, more focus in towards the downside with initial resistance approximately at 91 zone, and then we have more another is important at 93.80. Before this 93.44 is the 38.2% retracement, and 93.80 basically the gain of 93.80, 94 previous strong support, and the platform is seen required to improve and provide temporary relief. Otherwise, further slide lower as a negative tone continues to dominate on the lower time frames could be the likely scenario for the crude oil's price. Thank you all for being with us. That's all from my side. Do we have any questions for today? It seems no. Okay. It seems that again we covered the most interesting things. Whatever you were looking for, I think it has been included in our presentation. Also, you can see on the start page, you can see the email where you can submit all your suggestions, comments, or questions. I think you will see it now on your screen. It's analysis at windsorbrokersltd.com, and we'll be glad to get your feedback. Actually, what we need is improvement of service in any way, whatever is more suitable for you, whatever is necessary to be added or removed in order to improve the service. So also your feedback would be quite precious for us. I already have some good comments, but I would like to hear some critics also, as of course nothing is perfect. So if you have any suggestions, anything to be changed or done different way, or anything to be added, please don't hesitate. Send us your comments and feedbacks. It will be for a benefit for both of us. Again, thank you all for being with us. We are ending today's session, and we're of course back tomorrow morning at the same time at 7 o'clock GMT and 10 o'clock our local Cyprus time. I wish you a nice day and very successful and profitable trading today. Good luck.